Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of Thor Financial Technologies and Portfolio Manager of THLV, the Thor Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Michael Gayed. He is the CEO and founder of ATAC Funds. He's a portfolio manager of two ETFs, RORO and JOJO, which is risk on, risk off, and junk on, junk off. He also has a mutual fund, but a lot of you might have some familiarity with Michael from all of his work that he does on social media, whether it be podcasts, videos, articles, does a lot of market commentary, and he's really out there active in the community providing information. I absolutely loved this conversation with Michael. We talk about entrepreneurship, we talk about his strategies, and we talk about the funds as he sees them going forward. So I really hope you enjoy this conversation with Michael Gayed. Michael, welcome to the show. It's great to have you.
I appreciate the invite as always here.
So I have a lot I want to get into with you today, but let's start with your background. I'd love to hear about your background. I'd love to hear about how you got to where you are today.
So, I don't know if you have kids, but it's true that kids are very good at replicating their parents and mimicking what their parents' patterns and behaviors are. So family history here. So my father came from Egypt to the U.S. as an immigrant. One of those stories where he had no money, worked at a gas station for a small amount of time because he had to make some money, and found its way into IBM, got an MBA, loved and fell in love with the stock market, and then ended up working at Merrill Lynch, where he was on Bob Farrell's team in the mid to late 1980s. For those that don't know the name, I encourage you to look up Bob Farrell's 10 Rules. He was kind of this legendary technician when it came to investing, when it came to markets. So my father was on his team. I grew up seeing that. He left, started his own investment advisory firm in 1991, as I recall. Grew that to $1 billion in assets, was, large cap growth was the mandate. And then had his own hedge fund. And a lot of my passion for markets really kind of stems from me mimicking, going back to that point, his own passion for markets. And not just passion for markets, but passion for being an entrepreneur. He was always the kind of guy that wanted to build and have a better life, never stopped working. He himself was a big believer in cycles. And I think a lot of who I am today starts from kind of the framework that he kind of approached life with. But I joined the family business after college. My father passed in 2008. I was not of age to take over the business. Had a stage where I was debating whether to get an MBA to reset my career because that was just as the GFC was taking place, and I was a nobody. Nobody knew my name. I had just gotten the CFA charter in 2008. Horrible timing. It didn't matter to try to get a job, right? And ended up working for a family office for a year. After that year, decided I wanted to have more than one client. Worked for a small RIA. Started doing writing. Started getting a lot of content out there. Ended up eventually launching a mutual fund, traveling across the country, building a social media following, putting unique research out there, launching two ETFs. And despite all that, still the entrepreneur, because I haven't quite gotten to where I hoped I would be at this point.
Yeah, and that's one, an awesome story, and two, I can relate. And you're so right. My passion really came from, and it's funny. My dad had sold a business of his, and he took stock, and so he was constantly watching that thing, and he'd come home and turn on, CNBC and Jim Cramer, and that's where I got my bug, and it rubbed off on me. So a little bit of a similar path. I actually started my career in family office as well. So, but I ask everybody before we jump into the nuts and bolts of the interview, what do you like to do when you're not working? What do you have any hobbies? Do you have any things that are other than chasing your kids around? What do you like to do?
By the way, Sandra, it's for those that have never worked at a family office, you can appreciate this. When you work for a family office, the idiosyncratic aspects of the family are really pretty remarkable. Very wealthy people tend to be a little bit nutty,
Yeah.
in a good way and a bad way, but they tend to be a little bit nutty, especially when you're interacting with the family dynamics. Who's going to take the assets and the estate and all this stuff? Okay, so the truth is, I don't really do very much outside of work because I've got a lot of different things I'm trying to expose myself to in terms of running my funds, running the research, which is separate from the funds, doing other work related to Title Financial Group, which is the advisor RA that I'm under. Music is a big passion of mine. I'm a songwriter. I've got guitar, bass. Literally, I can turn my head right and I can see it hanging on the wall. So I'm a big fan of music just from a creativity perspective. But it's like everything else, right? I think when you are passionate about something, there's the element of it that is also fun, right? Yeah. That you don't necessarily think of as work. It's cliche, right? It's like if you enjoy what you do, you never work a day in your life. That's not always the case for all aspects of this business, right? But a lot of my days are candidly just focused on building. And this is the thing which is, I think, underappreciated. A lot of people talk about, well, the market's open from 9:30 to 4 Eastern, and then you can call it a day. It's like no. I mean, if you're an entrepreneur, doesn't matter what domain you're in, you got to keep pushing. You got to keep building. You got to devote your time. And it's hard, right? Because I don't necessarily believe in the idea of a work-life balance. By the way, neither does Bezos. It's like that narrative is just not true. If you're going to be an entrepreneur and you want to build, time is the most precious resource, the most finite, and is the one you have to use most effectively, right? And it takes a lot of time to build a business and to build a name and to build a presence. So, it's like you can't have it in the middle. You're either going to be all in committed, which means you don't have much time for yourself and don't really enjoy things outside of your work, or you take the risk and, you might fail, but at least you have a chance at really being something bigger.
Yeah. And it's with entrepreneurs, especially that entrepreneur mindset where you want to continue to grow. It's, every time we accomplish something, it ends up becoming another starting line, right? I mean, I think people come in and say, oh, we're going to launch an ETF or we're going to launch a product and this is it. Well, you just got started. That's your new starting line. So, it really never ends. And you're so right. And I tried to pick up guitar in college, and I have zero musical talent whatsoever. I have. So good for you for being able to play. I tried, but let's talk about the content for a little bit. And I gave you, I feel like I know you a little bit because I've been seeing you every day, twice a day, 3 times a day for years. Let's talk about how you're able to do that. Or do you have a team, or are you just in there every single day, elbows out and generating all this content, whether it be video, audio? I see all the clips on Seeking Alpha. There's a lot out there. So can you talk a little bit about how you manage that?
Yeah. Okay. So let's take a step back. So first of all, let me approach it from the standpoint of why I put the content out there as much as I do. Because some people seem to think that I'm doing that because I'm trying to diversify away from my world, which is my funds as the entrepreneur. In the fund business, there's only really 2 ways to grow, either a mutual fund or an ETF to raise assets, right? The old school traditional way is you have an army of wholesalers. It's very expensive, right? Hiring boots on the ground. They're out there, they're doing the steak dinners, they're doing the golf, they're developing their relationships, and they might get an allocation, if your performance is hot and they like the wholesaler. Okay. The other model is to say, view yourself as a publisher where you're putting a lot of content out, which is not related to your funds.
Right.
Which is related to you as the brand name, right? And build that audience. And then hopefully there's a halo effect because people see your content and then they realize, oh, this guy actually manages funds too.
Yep.
Let me take a look at the funds, right? So I've always had kind of more of that mindset in terms of my approach to content. Publisher first and hopefully monetize it really through the funds, right?
Yep.
So to your question, do I have a team? Of course I do. I mean, I'd be insane not to. Right? Everything goes through me, and I'm the guy that develops the ideas. But you have to do that, and you also have to recognize that different frameworks work for different platforms, and different ways of communicating work better in some ways in some platforms than others. So, when I deal with people on calls or when I do podcasts like this, obviously it's very professional, right? Because that's what I'm obviously going for. And that's kind of at the core of who I am. When I write things for Seeking Alpha or write pieces on the lead lag report, much more analytical, much more deeper dive, showing charts, explaining the reasoning. When I tweet, I'm very loud. I curse, right?
Yeah.
And like people say, oh, you're a portfolio manager and you're coming across so emotional and aggressive and you're cursing. It's like, okay, I have 740,000 Twitter followers. People want to be entertained. And the truth is the algorithm does amplify that. It's not my opinion. So, yeah, it's like I believe in being compliantly Machiavellian. Compliantly, the ends justify the means, right? From that standpoint. So from that perspective, it's like, all right, if that's what gets attention, that's what I'm going to be as a persona. But everything is ultimately about trying to build that brand name, that presence, and hopefully have the halo effect, right, of people then seeing that I have these funds, ATAX, RORO, and JOJO. Now, the thing is, of course, you can have an audience. They might like you and believe in you, but your approach may not be working because you happen to be in a cycle that doesn't favor your approach, right? And this is where I think a lot of people get tripped up. They don't distinguish between me as an analyst and rules-based strategies that would run the exact same way if I died tomorrow, that are, yes, based on my intellectual capital, intellectual property. I'm the guy behind it. I'm the entrepreneur that's funding it. But they can't seemingly understand that, like everything else in the business, there are environments that favor what you do, environments that don't favor what you do. And that's totally independent of me providing analysis and market commentary.
Right. Yeah. And I think patience, the ability to have the patience, especially we run a rules-based strategy, you run rules-based strategies. And we know when they're going to work. We know when they're not going to work sometimes. And so, you got to be patient in this game, I think. And as a follow-up to that question, I actually interviewed Mike Venuto on this podcast. He's coming out next week. And he was also saying to me, he was giving you compliments. Not only are you out there doing content generation, but you are heavily talking to clients and RAs and prospects. And so, how are you fitting? Whenever we schedule this, it seems as if you're very meticulous and organized when it comes to scheduling because you're getting pulled in a lot of directions. So how do you balance that? Are you blocking off time to say, okay, these are my client calls, this is my content, this is my podcast, this is when I'll do guests? How are you organizing your day?
Yeah, no. So it's first of all, it's not uncommon for me to do 10 to 15 calls per day, right? And those are conversations with prospects unrelated to my funds, related to partners of ours that I help try to get in front of the right types of allocators. That's related to those that are interested in launching ETFs at Title Financial Group. So to your point, it's highly, highly organized, right? And I don't schedule the calls. I obviously give a calendar link and people schedule it. And whenever I happen to have availability, I'm happy to spend the time. I even do that, by the way, for subscribers to the lead lag report, which again is a totally separate entity from Title Financial Group, meaning, I've got over 1,000 paying subscribers. I will literally one by one do a mail merge and say, listen, if you want to talk markets, here's my calendar link. Because I do believe that, especially because it's rules-based, I can do this. I have the time to do this. Life is a series of scratch-off tickets, right? Meaning you don't know which scratch-off ticket is gonna pay off for you, right? And I view every relationship like a scratch-off ticket, right? It's like you don't know who you're gonna help, and who's gonna help you. So I don't believe in burning bridges unless somebody's really going after me in a really aggressive way. But it's a lot of organization. It's a lot of going back to that earlier point about what do I do for fun. This is why I don't have much time, because I'm constantly putting content out there, doing podcasts, talking one-on-one to people. So a lot of what people see on Twitter, they think I'm just tweeting all day. It's like I should be focusing on so many things. I have so much time. It's like, no, it's that old expression. If you want something done, give it to a busy person. Yeah. Right. And really is that. And the organization part is really, really, really critical. Like I'm very adamant. If I have a 30-minute phone call conversation, I don't go a minute above that because I got something else to do.
Yeah. Well, that's great. And I've never heard the scratch off ticket analogy before. I like that. I might have to use it, but let's pivot because I want to get into your funds. That's why you're here. I want to talk first about ATAC mutual fund. That was your first baby. So what made you decide to launch that? And can you talk a little bit about the strategy?
Yeah. And actually it's funny because this goes back to cycles. Okay. So when I was at the other RIA, when I launched, prior to launching the mutual fund ATAX, I was getting a lot of media presence. I was writing on Seeking Alpha. I had written for Mark Faber of the Gloom Boom with Doom Report, Barry Ritholtz, John Molden, just contributing content. And I got a pretty big, at that time, a call. Right now, I say it's more conditions because I think I've matured in the way I think about markets. But back then, I had a pretty big call saying I think there's a summer crash happening in that's going to come in 2011. You can see those pieces; those are still out there. You had that August crash. The S&P is down 17% in 3 weeks. I was the only one that was aggressively saying it, very aggressively saying it in pretty much every single writing, like 17 articles of which in the title said summer crash. So it happened. Then I hustled to try to get a journalist to talk about it. Then I started getting the media, and all the while I had created basically a separately managed account strategy around this kind of risk on, risk off dynamic. In 2011, GIPS verified performance of that composite was up like 8.5%. In 2012, the GIPS verified performance of that composite was 45%.
No.
Right. And because I was getting so much media attention, I was kind of on fire at the time, doing Bloomberg, CNBC almost every other day. It's like, all right, well, let me launch a mutual fund with my partner at the RA. So I launched the ATAC rotation, what I then called the ATAC inflation rotation fund was the original name. We've since removed the word inflation. Now I happened to launch that strategy the day before quantitative easing 3 began.
Okay.
Now that's actually a very important marker for a lot of reasons. So the back testing on the model was really strong. The actual performance in 2011, 2012 for the SMA composites was very strong. Rotating risk on offense equities with leverage, risk off defense treasuries, long duration. And the risk on side is rotational across large caps, but more importantly, small caps and emerging markets. Because if you think about it from an asset allocation perspective, what's the only way you beat the S&P? It's one of 2 ways in the absence of leverage. If you're going to be equity long only, you tilt smaller or you tilt international.
Right.
That's it. It's not stock picking, right? From an asset allocation perspective, that's all you can do really to ultimately beat the S&P in a meaningful way, assuming the cycle's in your favor. So develop the model for the composites, bring it to the mutual fund. Day before QE3, the effect of quantitative easing 3 was that you effectively killed off left tail risk, which means you have an approach that thrives on risk off, on treasuries, in high volatility sequences for stocks. And every time you get a signal, the market says, screw you, I'm going to keep going higher.
Yep.
And that's because the cycle was so dominated by money printing, it squashed volatility. So I keep getting whipsaw playing defense.
Oh, yeah.
Right. And this has been the dilemma, not just for me, but for a lot of active managers, right? Which tend to thrive from downside. And, out of the gate, the mutual fund did well. It had, people were throwing allocations to it because they saw me in the media and I was on fire with a lot of things. QE3 happens. And then on top of that, it wasn't just a function of a cycle that, with the exception of 2020, was purely risk on and late 2018 with the Christmas Eve massacre. It was also that it purely was dominated by large caps, the cycle, the FANG phenomenon.
Yeah.
Right. So here I am. I created a model which prior to 2012 assumed there would be occasional risk off periods, but then on top of that, assumed that risk on meant persistence in small caps and persistence in emerging markets to try to benefit off of that drift, that momentum. Small caps peaked relative to large caps in 2014. Mm-hmm. Emerging markets, as you know, have been like volatile cash. Death by 1,000 cuts. Have gone nowhere, while the S&P has been the only game down. So why do I mention all that in the context of the mutual fund? My timing for launching that fund was horrible with hindsight because I happened to enter a cycle that favored pure risk on, which meant a lot of whipsaws around risk off, and pure large caps, which meant a lot of whipsaws around risk on small caps, risk on emerging markets. So that fund only really had 2 good years. 2017, lowest volatility year in history, a lot of whipsaws around risk off, but small caps and emerging markets had a real drift that year. So the mutual fund was up 27% in 2017. And then 2020, you had the COVID crash. It's in treasuries. It ends 2020 up 72%.
Yeah.
Aside from that, it's just languished, right? And it does go back to this point that every strategy is a function of the cycle that you operate in, right? I need a very particular environment for really all my funds. I need an environment where there's some left tail risk to have a chance of getting risk off, right? I need an environment where it's not just about large caps. We haven't had that in a while.
Yeah. And I have the same in the strategies we run. We need left tail risk and we need large caps to perform. So you and I would probably perform quite well in similar years.
Right.
Just out of curiosity, since you've launched the other two funds, which we're going to talk about here in a second, why choose to continue to keep ATAC as a mutual fund and not convert it?
Okay, so that's an interesting question. Okay, so a couple of reasons. So first of all, I differ from my colleagues in the view that ETFs will fully replace the mutual fund industry. And I say that because I think there's an incentive misalignment. So a couple things. First of all, as you know, inside baseball, right? With major wirehouses like UBS, for example, and other firms, Morgan Stanley, so on and so forth, they want to get paid for having your strategy on the shelf, right? So usually they take it from what's called the 12B1 side of the fee, right? The platform fee coming from the fund. They want to get paid just to have it be available. They do due diligence, and now it's accessible for their advisors, but they want their share. Okay. So wirehouses don't have an incentive to open the floodgates up to ETFs because they don't have that fee that they can grab. Okay. So there's an incentive misalignment there. The other incentive misalignment is that wholesalers, salespeople really don't want to promote ETFs. And there's a very real reason for that as opposed to mutual funds, which is that it's hard to get paid on what you raise. So in the mutual fund world, you can track flows, meaning you have some wholesaler or some salesman, they have some advisor relationship, that advisor ends up allocating. You can actually see that flow. You can identify who the advisor is on the mutual fund end. And then you can compensate the wholesaler, the salesperson, with something because you can actually tie it to that effort. With ETFs, you can't track it. You actually, for the most part, don't really know who the buyers and sellers are. So if you're a salesman or saleswoman and a wholesaler, and you're presented with a choice, do I promote a mutual fund where I can get paid more because it's trackable, or do I promote an ETF where it's not trackable? What are you going to choose? Of course, you're going to choose the mutual fund. Right. So to your point about why keep it the way it is, because first of all, I've already got some presence on wirehouses that would not consider an ETF. Yeah. I've got some legacy there. But I do also think that some advisors just naturally prefer the mutual fund vehicle, independent of the tax inefficiency of it compared to an ETF.
Yeah, that's interesting, and I agree with all of it. It's funny. I was talking to a handful of ETF issuers, and it's like we're maybe the only business that I can think of where you just don't know who your customer is. Like someone can buy the fund and be the biggest fan of it, and I have no idea who they are. I can't follow up with them. I can't build a relationship with them, and it makes them way harder to retain because of that. It's just very strange. I wish there was some insight, but
there is another dynamic which I think is also important, real quick, which is that. And I still see it, even though I think it's better than it was. But it's like, why did I create the mutual fund back in 2012 as opposed to the ETF structure? Right? When I first, the thing that worried me the most back then, and again, I think it's better now, but it's still a problem, is people confuse volume with liquidity. Mm-hmm. So you have an ETF that comes out, and you may believe in the strategy, you may like the performance, but the volume's not there. It's not trading, right? Because people are not buying and selling or transacting. Because you can see the volume, traders and investors will say, it looks like it's illiquid. I don't want to buy this ETF, right? Because this doesn't have the movement, even though the volume is irrelevant because it's about the underlying, right? Correct. It's where the liquidity is driven, and you're fine. And you do a limit order, and you'll never have any exit issues, right? Anyway, for the most part. So with mutual funds, you don't see that. So you don't have volume, right? It's just priced once a day, and that's it. So my point is, volume, I would argue, is actually a big detractor in getting assets, especially for newer ETFs, whereas that's not even a data point to consider with a mutual fund.
Yeah, I've had to do, let's call it education, continual education on this, because we're a fund of funds, as you run fund of funds, and the liquidity is the underlying of what we're trading, and not, and so it just comes to education, and it seems like everybody needs educated on that. But anyways, let's move on. I want to talk RORO and JOJO. Mm-hmm. Let's start with RORO. It's extremely interesting strategy. It's extremely simple, yet very thoughtful. So can you kind of walk me through the idea behind the strategy, and also talk me through the strategy mechanics itself?
Yeah, no, and it's also one that, no different than ATAX and JOJO, I timed wrongly in terms of when to launch, because it relies on long duration treasuries to play the safe haven risk off side. Okay, so like the mutual fund, it's rules based. There are indices that are back tested. Somebody can look them up on marketvector.com and see the theoretical returns of the RORO strategy and the JOJO strategy. The ETFs are designed to try to track those indices. So the concept's very simple. So it's actually based on one of these papers that I'm known for, that won the 2015 Founders Award as a sort of starting point. Basically, the idea here is that lumber is a tell on housing. So the average home has 16,000 board feet of lumber. Lumber is highly correlated to housing starts. It's probably your best real-time way of seeing the demand for construction activity. Housing makes up 18% of the economy's GDP. And as lumber goes, so too typically does home values, right? So if you believe that housing is a leading indicator, you have to believe lumber is a leading indicator. Just like, by the way, if you believe industrial activity is a leading indicator, well, then copper.
Right.
Right. It's the same kind of concept, but in this case, I'd argue far more predictive because most people's wealth is in their homes. Yep. Now, you compare it against gold, which is more of a safe haven, flight to safety type of commodity. It turns out that usually when lumber is outperforming gold, stock market volatility is lower. When gold is outperforming lumber, stock market volatility is higher. Not based on my opinion, based on pure fact. And it relates to that idea that why would lumber be doing well? Because it means housing is going to do well. Why would gold be doing well against lumber? Because it suggests that there's some kind of credit contraction. Now, that's sort of at the core, which impacts volatility. So in 2020, when the mutual fund ATAX got the COVID crash right, it was in treasuries mid-January in long duration TLT. It's up like 30, 40% coming off the low and then goes fully into equities. I tell my colleagues at Title, listen, I learned a lot from the mutual fund space. With hindsight, I think I made the mutual fund overly complicated, right? And not necessarily in terms of the strategy, but in terms of the communication. Get risk on, risk off, utilities, treasuries as signals, small cap, emerging market. Like you got to keep it simple also from a story perspective. So I said, okay, listen, I got this lumber to gold relationship. People find it interesting. I've presented on it all across the country. Let's create an ETF. So we went out, started that process, created the index with market vector. And it's a very, very simple, to your point, approach. So if lumber outperforms gold over the last rolling short-term time period, it goes risk on, leveraged, 1.3x small cap, large growth. Right? If gold outperforms lumber, it goes all in long duration treasuries, TLT as your proxy. So it's only playing with kind of three parts of the marketplace: small cap, large growth, risk on, levered, static, risk off, long duration treasuries, which tells you why I went through so much hell last year. So I always go back to this point, and because you mentioned that you run rules-based strategies, I'm sure you can relate to this. Every strategy is a function of three things, right? What's your signal? What's your look-back period on the signal? But then, most importantly, which people really underappreciate, what is your opportunity set? So the problem is, I launched RORO November 2020, had an okay 2021, nothing to write home about. But then here comes 2022. It's a risk-off year, right? In the sense that you have, on average, higher volatility. You have, on average, equities going down, quite a bit, actually, at the lows. But you have, for the first time in history, long-duration treasuries losing more money than equities.
Yeah.
Right? And the signal was actually risk-off the bulk of the year. But because the expression of risk-off from a rules-based perspective is long-duration treasuries, for good reason, by the way.
Yeah.
I could do nothing but take the pain. I called it hell many times over. And that was the same dynamic with ATAX, although ATAX, the mutual fund, can be short duration. Same dynamic with JOJO, which doesn't use leverage. That's the bond thing. So they all have this commonality that they all rely on that flight to safety dynamic in treasuries. So it had a horrible, horrible drawdown. Now, the thing is, it's like I launched the funds for a reason. Last year was an anomaly. A lot of people will say anybody could have seen this coming. I completely disagree. Not from the standpoint of the idea that stocks and bonds are both going to lose money. It's about the how. It's about the interaction. I keep going back to this point that 59% of the weeks in 2022, the S&P 500 lost using weekly data, was negative. The only other time you had that kind of sequence was 1931. But then on top of that, the number of weeks that long-duration treasuries lost money, that yields rose, was 74% of the year. Most ever in history in terms of the sequence. So you have an extreme in terms of the path behavior of equities, as a standalone, extreme in terms of the number of weeks that you lost money with treasuries. You have a weekly approach trying to rotate the two, you're damned. You can't possibly work with that, right? So I launched at the exact wrong time. Now, and then JOJO 2021, I launched the same idea, treasuries as the safe haven. Now, the thing is, like, there's always this sort of interesting dynamic in this business, which, again, I'm sure you can relate to, which is that you launch some approach that's not working out of the gate, right? Cycle doesn't favor it. You believe in it, you know the research, but you also know that markets live in the long term, but we live in the small sample. So people don't care about long-term data. They care about what have you done for me lately, and not what have you done for me, over multiple years.
Right.
So there's an interesting question you have to ask yourself as an entrepreneur in this business. Are you keeping a fund or a strategy alive because you believe in it, or are you doing the wrong thing by keeping it alive, subsidizing the expense because you're falling for sunk cost fallacy? right? That you're committed to the approach, but it's just not working. But so you keep throwing good money after bad. Or if you do decide it's sunk cost fallacy, in which case you close that strategy, are you then closing it at the very moment that strategy is about to turn around?
Yeah.
Are you selling the low in that approach, which is not raising assets, because the performance sucks, because the cycle doesn't favor in that moment in time that methodology? Right? Mm-hmm. And I'll tell you, that is nobody on FinTwit, nobody that's outside of this can possibly understand how challenging that is, because you don't know the answer to that except for hindsight.
Right.
Like, I believe in my approach. I know the research. I know the cycle dynamics. I know that I happen to launch. It's not an excuse. I can show all the data of how unusual the last decade has been because of really QE3 breaking a lot of intermarket relationships. Does that mean that I should give up after 10 years on the mutual fund, or does that mean I should give up on RORO after it just went through a historic collapse in the risk-off flight safety trade? Or if I could do it all over again, would I today launch the funds now?
Right.
Right. And like, the answer is unequivocally, if I could, if I knew the perfect foresight I'd enter a year like last year, I wouldn't have launched. I'd launch now, though, because now you've got room to make money in treasuries again. You actually reset the entire dynamic. But so that's why I'm like, there's a part of me that has been wildly frustrated and has the anxiety as every entrepreneur does. Right. And I'm putting myself out there. And that's nervous. But at the same time, it's like, I'm also oddly really optimistic.
Yeah.
But you also have to get past a lot of these dynamics, which still are, I'd argue, very kind of unusual post-COVID.
Yeah, it is, like we said earlier, timing can be everything. And, 2022 was just a horrible year. I mean, even if somebody was passive 60-40, I mean, every single story broke.
Even oil broke, by the way.
Yeah.
Oil stopped in June. Everyone was saying oil. And that was it. And then, I mean, narrative follows price. It always looks easy with hindsight.
Yeah.
Okay? But again, I go back to, it's not about the endpoint. It's about the dance in between the endpoints. It's about the sequence, the path.
I have one more quick question, simple question about RORO. Is it a real-time trigger, or you said that they're indexed approach? So are they technically passive strategies?
It's definitely active because it's using weekly decision points, which are sent by the index provider, and then we basically rotate based on that.
Okay, gotcha. And then let's touch briefly. I know we're running out of time here. Can we touch just really briefly the strategy on JOJO, what that rotation looks like?
Yeah, so it's a similar conceptually to everything else. So the idea here is that risk on, risk off is about volatility, which is why you want treasuries, because usually in high volatility sequences for stocks, there's a flight to safety trade in treasuries. So there's also a link between volatility in equities and credit spread widening. Right? So if you look at the VIX and you overlay it against option-adjusted credit spreads, you'll see like a one-for-one relationship. Basically, what happens is when you have high vol in equities, the bond market perceives it as increased default risk.
Mm-hmm.
Right? So junk debt widens against AAA, and that's where you get events. Right? So the whole idea of JOJO is not to use lumber to gold; it's actually to use the utilities relationship. Same idea though. Utilities outperform the market, typically higher volatility. They underperform lower volatility. Low volatility regimes tend to be good for credit narrowing. High volatility regimes tend to be better for credit widening, for spread widening. So in that case, it's either all-in junk debt, right, as the junk on, risk on expression, utilities underperform, or all-in long-duration treasuries, right? Now, again, it's like the frustrating thing about last year is that the junk was treasuries.
Yeah.
Right? It was duration. Right?
Yeah.
So that approach really does need, as a bond rotation strategy, really does need a spread event. It needs to have one of these blowouts where junk debt is yielding like 20-30% because everyone's just dumping it while treasury yields are dropping. So you make money in treasuries, and then hopefully you go back at the high yield and much higher yields whenever you get the junk on signal back. Again, I happened to launch at the wrong time, right? It's not an excuse. It's just fact. July 2021, right? So now the thing is, like, I really do believe, and yeah, you can argue I'm biased on this. I don't disagree on that, by the way. I really do believe there is a credit event out there, right? And whether or not that fund can get it fully or even partial, I have no idea, because the signal has to get it right. I believe in the signals, right? But I at least need to have a chance, right? And that chance means I need to have some volatility, some risk off. Now, if I'm right that you have a credit event, flight to safety research, recession happens, and suddenly there's convexity, right? In the performance, hopefully, of all of my funds. And this becomes then the real big challenge, right? Which is that suddenly people start chasing the performance of the funds when they should be buying it now in advance of that.
Yeah. Yes. We struggle with that. a lot is strategy performance chasing. And then they go, hey, wait a minute, this thing was up 50% last year. I said, yeah, well, you should have bought it the year prior.
Right. It is maddening that people do not understand that. It is, and it's so, it's like there's so many studies on this. It's like you look at Morningstar, what they call the Morningstar curse, right? Those funds that are ranked like 5 stars the last 3-5 years tend to be among the lowest decile the next 3-5 years. Those that were in the worst 1 star over the last 3-5 years tend to be in the 4 or 5 star category. Why? Because there's cycles, there's mean reversion, right? People forget that, most money is not made after performance already happens. It's not in the middle of the trend. It happens at the turn of the trend.
Yep.
Right? And it's hard for people to really understand that because everyone is just a basement trading squiggly line technician, and they want to see momentum already take place, not understanding how compounding works.
Yeah, it's so true. 2 quick last questions. When you're talking to advisors and RIAs, where are you suggesting where are you sliding in RORO and JOJO as part of an overall model portfolio allocation? Yeah,
I appreciate the question. I mean, these funds were never meant to be core holdings, right? They were always meant to be alternative 5-10% because they're very active. It's people think I'm anti-passive. It's not I'm anti-passive. I just believe in diversification.
Yeah,
it sounds strange to say, but it's like diversification isn't passive asset classes. Diversification is also diversification of strategies.
Yep.
Which I have a very particular type of an approach that needs a very particular cycle. I need a cycle which is not dominated by large caps and where there's risk off. If you're in a cycle that does not have those dynamics, passive S&P is beautiful. That's actually the ultimate diversifier against what I do, oddly enough. But because it's so active and because the truth is, most of the time, the S&P is the winner, although by magnitude, I can really catch up like I did in ATAX in 2020 with the right setup. You better to blend the two, right? But do it weighting-wise properly. So much more in that 5-10% range, kind of satellite of the core satellite approach. JOJO, I actually think of the 3 funds becomes the most interesting because at least it's got yield and income because it's a bond strategy. That can be a larger weighting. And if you believe there's a credit event out there, I people will be shocked at how, I hope at least, that fund can suddenly be the number 1 fund in the bond category because all you need is one of these credit events and hopefully get most of it right, and then define like years of performance.
Yeah. So last question, more of a fun question. When have you trademarked the word few yet? Or when do you pull out the few?
Well, few understand that few is not from me. As I always say, it's like I started doing that because the whole Bitcoin maxi crowd went after me in 2021, and that was they were saying few understand this because it was a meme that was from 2017. So because I'm a very stubborn guy, I started basically stealing that from the Bitcoin maxis because I thought it was ridiculous the way that the overconfidence was playing out. So then I added exquisite and atrocious. I put the lumbering gold eyes to poke fun at flavor eyes. Right. So it's like, and it goes back to my point about the persona on Twitter, right? It's like I'm trying to be entertaining because the reality is I don't know what else to be. Going back to this point about people can't differentiate between me as an analyst and my own funds. So I went through a horrible, horrible drawdown last year, right? If I'm going to be a dry analyst, people are going to see my research and say, why the hell should I pay attention to you? Look at how crappy your funds did. Totally ignoring the context, the anomalous nature of last year. So how do I keep the attention? I have to be somewhat loud, somewhat entertaining. I have to frame things in ways that people will say, you know what, this guy actually is onto something, even though his funds didn't do so well. Right? And I have to basically buy time for the cycle to come to me. Right? It's like people think that this is me being, going off the rails. No, it's actually a very purposeful strategy because I don't know what else to do to keep the attention on me and then by extension my funds when the funds have gone through such a big drawdown and nobody's going to look at the funds now until after the fact. But by the time they realize after the fact, the performance already happened. So I've got to just keep out there as much as possible. That's why I'm so stubborn with this stuff. Yeah.
Well, I got a good chuckle when I saw the lumber and gold eyes. It really was, it really was funny. And look, I really appreciate your time. This was super informative. I wish you all the best of luck. I also look forward to hopefully running into you at a conference someday and shaking hands in person. So again, thank you for taking the time to sit with us and where can people find out about your funds?
Yeah, no, so it's atacfunds.com, ATAC, atactical. It's just a play on that terminology. And then I'm on @LeadLagReport on Twitter, Instagram, YouTube, Facebook, and of course, leadlagreport.com, also on Substack. So I am, as you were saying in the beginning, right? Like I'm in a lot of different places. As I like to say, I am everywhere, but I'm also nowhere at the same time.
Yeah. Well, Michael, thank you again. And I appreciate your time.
I appreciate it.